If you're self-employed and getting a mortgage seems harder than it should, then this episode is for you. Welcome back to the Rock and Realty Podcast. Today, I'm giving you a backstage pass to the world of self-employed mortgages and answering some big questions like, how do you know your business is mortgage ready? And if it's not, what's the game plan? Today, I'm chatting with Ahmad El-Farram, a mortgage agent with Capital 360 Complete Mortgage Solutions, specializing in self-employed borrowers. That includes sole proprietors and incorporated owners. So this is going to be a good one. And please don't forget to hit the subscribe button so you never miss an episode. I've got some really good ones lined up. Let's get into it. So if you're looking to make your next move, whether it's to Orangeville, Dufferin County, or the surrounding area, people just like you reach out to me every single week to help them with their next move. And I would love to have a private conversation with you to see how I can help you make the right decisions, avoid costly mistakes, and properly guide you through the process. Click on the link in the description below to set up a time. Now let's get into this episode. So on today's episode, we have Ahmad, who is a mortgage agent who specializes in self-employed individuals. I'm really excited about this session, and I hope you are too. So let's jump right in. Ahmad, welcome. So happy to have you here.
Oh my God, thank you so much. And yes, very excited to be able to do this. Like I said earlier before we started recording, was thinking about it all week. So thank you for the opportunity.
Yay. Oh, that's amazing. So for anyone who doesn't know you, who are you?
Such a deep question. Who are you? I
Let's
reflect
get
on it
started
every
right
day.
deep.
Yeah, right. Let's get right into it. So my name is Ahmed. I'm a mortgage agent with Capital 360 Mortgage. We are part of Mortgage Center Canada, which is the biggest network of mortgage agents across the nation. And we actually originate more mortgages than all of the top 5 or 6 banks in Canada. So it's a great network with a lot of resources.
How did you get into mortgages and what pulled you into serving the self-employed?
It's a great question. So I think the biggest draw for me, number one, when I got into mortgages to focus on self-employed was the fact that I've always kind of been self-employed my whole life. It's all I've ever known. And going back, 30 years ago, coming out of high school, I wasn't sure what I wanted to do. And I remember having a conversation with my father, God rest him. I said, I'm not sure what I want to do. And he's like, listen, and he was a professor of nursing. And at the time he had said, Ahmed, he's like, whatever you do, you're going to be good at. I know whatever you put your mind to it. He said, but basically, whatever you do in Canada and this country, if you want to create financial freedom for yourself, you want to be self-employed. And he understood that even being in education his whole life, there wasn't a dinner that he wasn't at the table for. He was always there after school. He was there every weekend. So, he chose a career path that allowed him to have that family time. And I think that definitely left an impact on myself, my brother and my sister, because we were all kind of self-employed. And he said, listen, it's not about how much money you make, because you can do any career that makes great money, but it's how much you can actually keep. And that's always kind of resonated with me. And ever since I was 18 years old, opened up my own business and kind of never looked back. It wasn't easy. And I remember, so thankful to him. First thing that he did was found me a business coach. We put together a business plan and got rolling from there.
Is there a client story that you have that made you realize self-employed individuals have a different playbook when it comes to buying a house or getting a mortgage?
Yeah, I mean, there's probably two kind of avatars that come to mind. And I think generally, like, I am also my own avatar. So if I look back on my career, it took me 15 years of being self-employed to figure out that we could actually qualify for a mortgage, right? Like, and it's really, I want to say maybe due to stigma or due to uneducation that there are products out there designed specifically for the Canadian entrepreneur, and the strategy that most entrepreneurs have is they get incorporated. They make a decent income, whatever profession they're in, and they end up sheltering that money in their corporation and living off of and withdrawing from their corp to their personal only what they need in order to maintain the lifestyle that they want. And what you end up seeing is that, you have a very high corporate income and then your end of the year personal income becomes significantly lower. And this is a strategy that's not new. And this is why people incorporate. But what happens is, in regards to the understanding of the mortgage process, when you walk into a bank, the first thing they're going to ask you is like, what do you claim in personal taxes, right? So, they're implementing one strategy, but they're trying to qualify based on the standard strategy that they only know about because maybe their parents knew about it. And again, it's like the passing down of information. And I think that's been the biggest exciting part, and also the challenging part is kind of releasing the stigma and saying, listen, I'm not talking about private mortgages when you qualify as a self-employed individual. I'm talking about mortgage products that are designed for businesses that are implementing this strategy. And if we can show money in the corporation, and we show, a decent amount of transactions throughout the year, you have a healthy business, regardless of what you're paying to the government at the end of the year.
Fantastic. What excites you about this niche? You're so passionate. I mean, I found you on Instagram. I like locked in and came after you because as soon as I saw that you focus on self-employed, it got me excited. So what excites you about this particular niche?
I think it's the look on people's faces when we can actually show them what they really qualify for. And I'm a very visual person. Like previously, my business was in photo and video and marketing and things like that. But it was all at the end of the day customer service. Seeing people's faces, business owners that have been, for example, a contractor comes to mind that was a drywaller in Bradford, and was going through a divorce, got divorced, was looking to reestablish himself with a new partner and move forward. And again, it was this situation where, year after year for 14, 15 years, personal income was sitting at about $45,000. But when it came time to qualify for a house, that became a very challenging experience and kind of an eye-opening experience for them. And then we introduced them to if we were to get into the weeds, it's called a stated income mortgage product with some of our lenders. And most lenders offer it. They just don't really advertise it. It's not available, walking into a branch and things like that. But basically, it looks at the health and success of a business based on a 12-month window, right? What are the funds coming in? What are the funds going out? And what are the invoices or contracts that are in place? And in his particular situation, there was, let's say, a 2-year average of about $250,000, right? So in his situation, the question that I always, you have to ask yourself is, does it make sense to wait 2 years, boost up your personal income significantly, pay the tax on that just to qualify for a mortgage, when you can essentially look at that 12-month window of your business, bank statements and your corporate statements, and qualify on that? The trade-off is basically, a slightly higher interest rate. But at the end of the day, when you do the math on, let's say, a five, six, $700,000 mortgage, boosting your personal income from the 35% tax bracket up to the 50% tax bracket, that's a huge chunk of money that you're going to lose at the end of the year. And if you don't have to do that, it doesn't make sense.
It's amazing. I love that you've already started to give some really incredible value in this session today because understanding what the lenders are looking at is critical when it comes to a mortgage, right? And what do you think is the biggest misconception people have about qualifying?
I'm going to say hands down, the biggest misconception that people have in regards to qualifying for a mortgage when you're self-employed is that the lender is concerned about what you claim to the government at the end of the year. When we talk about, let's take a real estate agent avatar, for example. When you talk about, let's say, successful realtors, let's say they're making commission statements are coming in at, let's say, $250,000. On their personal taxes, they're only claiming, let's say, $65,000 or $70,000 because they're taking advantage of tax write-offs, which is totally legal, is on the up and up, and they really should be able to do that, right? But what happens is those write-offs in regards to the CRA and your accountants are not necessarily the same write-offs that you take into the equation when looking at the business expenses when qualifying for a mortgage. So what does that mean? It means, as a realtor, what are we looking at as your true expense to operate your business? All right, so maybe you've got your dues every single year. You've got, that maybe that includes your insurance. Maybe you pay a desk fee. You've got a brokerage fee, that kind of thing. You've got your phone. But realistically, food and entertainment, not a true, like, you can actually operate your business without things like that. So by not removing those as write-offs and keeping that in the business, and basically not taking that into consideration, all these additional things keeps your gross income higher. Now, the biggest thing that keeps your gross income higher is the fact that whatever you draw from your business to pay yourself personally does not have to be withdrawn from the gross to determine the net. And that's the biggest part of it, because most entrepreneurs are taking money out of their business, but they're justifying it through write-offs with the CRA and their accountant. But really, they're paying themselves. So what you pay yourself because you're the owner operator doesn't need to be withdrawn as a debt to the business. And that keeps the net income significantly higher.
Now, for those brand new entrepreneurs out there, what's the difference between like the gross income and the net income? And why is that? Why is what you just said affect those numbers?
This is a great question. So gross is going to be, let's say, every commission statement that you got, every commission check that you received, let's say over a 12-month period. Add those all up before you start, deducting any of your expenses in regards to the business. That's going to be your gross income. Now, your net is what you end up with. And if we talk about in regards to CRA and taxes, your accountant is looking at every itemized line and deducting it legally, which you can do, deducting that from your overall gross income. And once all those deductions are made, you're left with that net income. And generally, that net income is what you claim on your personal taxes. And it's going to be low because the whole idea is that you pay the least amount of tax on the personal side, because it's a much higher tax bracket than the corporate tax bracket, which is generally 12.5%. Whereas on the personal side, it can be, 35% and go up depending on how much income you show.
Thank you for answering that. That's really helpful. Really excited about the next few questions that I have for you, because we are really going to take this and look at it from two very distinct perspectives: qualifying as a sole proprietor, but also qualifying as an incorporated owner. And so what are the different playbooks for each and things like that? So let's jump into the first question. We all in this business of sales and so on have what's called a discovery call. And in your discovery call, in the first 10 minutes, what are you listening for to help decide whether this person is ready now or they actually need a plan first?
All right, so that's a great question. And I've got my form up here that I usually use for discovery calls. And when we're talking about self-employed, even before doing an application, we're having a phone conversation, because number one, I value their time and I value my own time. I don't want to waste their time going through the process of filling out an application, taking a couple days to collect all the income docs, only to find that there's a roadblock currently in place that is basically a hard stop on them even qualifying. Some of the big questions that we go through at this discovery call is, number one, what's the business name? I want to understand the ins and outs of that business. What services are they providing? Okay, so I'm listening for things like how they're getting paid. Are they invoicing? Is there a cash component to the business? And we can talk about a little bit about that later on, but a lot of construction and contractors, there is a cash component to the business because that's just the nature of the industry. And there's nothing wrong with that. And the banks allow us to say, okay, you know what? On the books, we've got 150,000, but off the books, there's about 35,000. And it's not something that you need to hide from the bank. And I think that's another big misconception, especially people that are in the trades, right? So the other question that I'm asking is, what is the structure? So I want to have a clear, definitive pathway. Are they a sole proprietor or are they incorporated? Because both are going to be a little bit different. Once we get through that, I'm very interested in regards to how their bank statements and their banking is organized. For most individuals, I would say probably 45 to 50% of the entrepreneurs that I meet, they are not ready today, right? And they're not ready today because no one's explained to them how the banks want to see their statements organized in a way that tells a story that they are serious and that they are not a risk. Okay. And this is where the conversation begins, where, like, okay, so do you actually have a business bank account, or are you using a personal bank account where everything is all jumbled in together and it's a bit of a mess? And you can see how that would basically sound the alarm with some of the lenders, where it basically just says, I'm not organized, I'm not taking things seriously, and I am a potential risk because I can't even keep my business and personal expenses and transactions separate.
Red flag number one.
Red flag number one. Number two, well, not red flag number two, but it could be. When did you officially register your business? Okay, and this is a big one because most lenders are going to want to see a 2-year history. Now, there are exceptions to this. So, number one, the bare minimum, the business license had to have been registered um, 12 months or greater. Okay. So you have to have had that business license active and it needs to be active. And it's actually interesting. And years ago, I fell victim to that where my business license after 17 or 18 years, I forgot to renew it because I somehow missed an email. And sure enough, it caused problems and there are ripple effects to that. So you want a business license that is at least 12 months old. And then the other thing is, how long have you been in the industry? So a lot of professionals have worked in the industry that they're currently in, and they have their business in, but it wasn't officially an independent sole proprietor or an incorporation under their name until recently. So in those situations, yeah, as long as the license has been 12 months, they've got a history of being in contracting or construction or whatever they've been doing for 3, 4 plus years, that's a win. We could tell that story. We can sell that story to the bank.
So, how long someone's been in the industry is important for qualification?
So the real takeaway in regards to asking the question about the business license is that the bare minimum, we need to have an active business license for at least 12 months. Okay. And what that means is, yeah, they want a 2-year history, but let's say your license is only 13 months old. So it's crossed the 12-month threshold, but you've been in that industry for 2, 3 years. That tells a story that we can sell to the bank and they understand that. It's something that, is very, very common where someone works in the industry and then eventually becomes self-employed in that same industry. So they make an exception on the length of the business license.
So interesting. There's so many variables to that qualification that, I mean, I didn't even think about. And so thanks for sharing that. When you're on this discovery call, what are some green flags that you're looking for? They're like, yep, this person's ready now. And what are a couple of red flags? And I think you mentioned a couple already, but what are the clear red flags that are like, nope, this person definitely needs to go on a plan?
Yeah. I took you as a cup half full kind of gal, right? So you started with what's the green flag first. So I appreciate that. I like that a lot. Green flag for me, if I were to tell you who my perfect avatar is in regards to self-employed clients, it's going to be like that contractor. It's going to be that real estate agent, someone who is incorporated. They've been in business for, 3+ years. They don't have any employees. Maybe they have contractors that they, independent contractors bring on and they basically get invoices from and they pay them. But we're talking about, small business owners, usually one person. I really love when they're incorporated because generally they have a good accountant and most people do. They already have the structure in place. Now I'm just coming in and fine tuning it. One of the things that I had said is that, the majority of the people that I meet aren't ready today. And I built my business around speaking to the majority of the individuals that I meet. And those are people that are not ready, right? Because a lot of agents and brokers, they're looking for the deal right now. I'm thinking, you know what? I've been an entrepreneur. I've been through the struggles. I'm now coming on to 28 years. I never had anybody show me these things. So to be able to nurture that relationship and play the long game with them, I can basically have, as long as everything is on the up and up, I mean, I'm going to go out on a limb and say I can basically have anyone mortgage ready in 12 to 24 months. And I'm willing to put the time in to work with them on a monthly basis to get them there.
Yeah, it's so interesting you say that because I think about the same, I think the same way when it comes to real estate and clients that are ready to buy now or are buying within 3 months or buying within 6 months or selling. Same thing is there's a plan, a preparation plan that you have to put in place. Some are more immediate, fast, put it together. I have a client right now that I just picked up that's like 2 weeks, let's put it on the market. So it's very fast, but they're ready. They're ready to go. They've been ready for a while. And so others may not be as ready or maybe a little bit more apprehensive, especially in this market. And it's really just walking them through all of the details and ensuring what they need to be prepared for, how to prepare for it, and how to get the best, the best amount for their property. So I am with you on that. When
And
you
it's tough. I just
Yeah,
wanted to say, like, it is tough. A lot of people are hesitant. Listen, we're talking about, the equivalent of a financial physical, right? So it's not
that's
a comfortable experience.
probably more
And
painful. Sorry.
it can be from time, but here's the thing. It's like, you don't know what you don't know, right? So
True.
you have to be willing to, look at the real numbers. There was this thing that I heard about in regards to like even debts and things like that, where people they don't even open up the letter
Right.
because they know that there's there and they're okay not opening up at that letter and looking at, so really what we're doing is I am, so I understand the hesitation with a lot of people. There's that aspect. The other aspect is the misunderstanding about the cash portion to certain businesses,
Mm.
right? You know, you talked about being, growing up old school blue collar. There was a cash component. There still is. Like, and it's understood that that's part of that business. But to open up your books and to disclose, I understand the hesitation there. And the real takeaway from anybody that watches this that has a cash component is that the banks know and they don't care. They want to know that there's more money, and that's
Yes.
okay. They don't talk with the CRA. They're not gonna rat you out to the government.
That's a really good point.
Yeah.
When you're having these discovery calls, is there different questions or different first questions that you approach a sole proprietor as opposed to an incorporated owner or vice versa?
Yes. So, I'm gonna reveal the curtain here a little bit, full disclosure. So
Backstage pass, everyone.
right? Love the rock analogy. I'm down with it. Okay, so the discovery call usually lasts. I like to say it's 15 minutes. In reality, it could be an hour. It's like this podcast, right? You start with a set amount of time and you end up talking and it goes to different pathways and things you didn't anticipate, which is good because you're building relationships. So one of the things that I had to implement in my business in order to run it efficiently was even before doing the discovery call, I have what's called a it's kind of a questionnaire that's called, "Is your business mortgage ready?" Right?
Yes.
It's literally 8 questions. That is what I'm going through right now with you before we even get into the discovery call. So, and again, these are things that we talk about during the discovery call, but if someone answers the questions in a way that says, "Listen, I'm a sole proprietor, most of my money is underneath my mattress and it's a disaster," I can't necessarily have a discovery call and think that we're going to be talking about strategy. So
Right.
what that ends up being is more of a, introductory call where we talk about, hey, listen, it's an expectations thing where, okay, here's what I'm willing to do. Are you willing to make these changes? And that conversation is much shorter because I want to protect and value my time and keep myself available for clients that are serious.
I'm curious, though, if there's anything in that conversation, whether it's the first one or the discovery call, where a client says something and it completely changes the trajectory of the conversation. Maybe you initially thought that, no, this person's not ready now. And oh, okay, maybe I was wrong. Is there anything that comes up in that conversation, something they say or share that can do that?
Yeah, so definitely. So, when we start looking at if they're buying with a partner or a spouse, there are a lot of other professions out there that aren't self-employed that obviously make fantastic income. So I think what ends up happening and has happened in the past, starting a discovery call, which we thought was headed in the direction of a incorporated business owner, ran into a couple roadblocks. Then the conversation went into, okay, well, who are we buying with? And then we jumped into their income. We jumped into their story and what they're doing for a living. And you find out that well, the, it's basically a 50-50 contribution and they're bringing a lot to the table as well. Where, okay, is it enough income in this particular case? It wasn't enough income to qualify for the particular home that they wanted, but we were able to bring on a cosigner that was a parent. So now we had a new business owner that pretty much ticked off all of the boxes with the exception of a few. They found the house that they want. So this is number one. They found the house that they love in the area they wanted to be in. So they were willing to think outside the box with me. It didn't work with their first strategy, which was the self-employed individual that had been in business for 3 or 4 years. The partner, had a stable government job, made a great income, and we were able to qualify using that with a cosigner from her parent. Now, the trade-off was this. The trade-off was not necessarily a trade-off, but they had to, I guess, put their ego at rest and put it at bay to say, you know what, we need the help. This is how, even though we can, on paper, we can afford this. Clearly, we're not getting in over our head. We're not getting a cosigner because we need the down payment or we need the extra income. We're doing it because the chips didn't align because of the self-employed business. And it turned into, a standard, regular qualification that I was actually able to help them with. And then we got the deal done and they ended up purchasing the house. Now the strategy was, okay, what are we going to get them into? Well, we're going to get them into a 3-year mortgage because that made sense in regards to the terms and the rate, but it was also a shorter time period so that he had 3 years to get his stuff in order so that when the time came and it came up for renewal, we took mom or dad off of the title of the property, and then we transitioned him back in.
Perfect. What a great strategy for those younger entrepreneurs, and there's a lot more these days, as I mentioned earlier. And it got me thinking about another question I have for you around how much more strict or risk adverse are lenders? How has it become more risk adverse, less risk adverse? Like, are they asking for more from sole proprietors and business owners and incorporated owners? I'm just curious.
Yeah, it's a great question. In regards to mortgage lending as a whole across the board, there's no doubt that it has become more challenging, right? I think the biggest, and something I got from my broker owner Vince Agazino, and he says it all the time, and it's kind of I echo it now. Is my biggest competition and the biggest challenge in the industry is fraud. Okay, so that's our competition, our number one competition, and that is also the biggest challenge in the industry as a whole. And we have the governing body FISRA, which is implementing more rules, being more thorough in regards to documentation and rules and compliance for mortgage agents and brokers. So that's been a big challenge. But at the end of the day, it's all good because we're looking to, we're trying to our best to eliminate fraud and make it an even playing field. Now, in regards to self-employed, um, you know, back in the day before my time, from what I heard, there used to be a stated document that you could just literally write your income and you write what you made. With a pulse and a handshake, you could get a mortgage back in the
Away we go.
the early 2000s, late 90s. I never, and in fact, you could actually get a property at 100% loan to value, so you didn't even need a down payment. And this was a couple years. And funny enough, there were no problems at that time. So lending has definitely gotten more challenging. And I think what is adding to that challenge is the fact that we're competing with fraud. Now, what does that mean? It means that number one, it's very important that, whether it's me or somebody else, whoever you work with, that they're part of a good brokerage. They're part of a brokerage that has, skin in the game, that they have been around for a while, that they have connections with banks. Every mortgage agent and broker is going to tell you I work with 200 lenders, and they don't. I'll tell you, and listen, this is a rock and roll theme podcast, so I just cursed, okay?
To
This is the
bleep, because I don't
backstage.
know.
Yeah,
I'll have to
I'm
bleep you,
sorry.
but that's okay.
You can bleep me. It's even more sexy when it's bleeped too, by
I
the
know,
way.
I'm
So because
totally
they don't know
bleeping you.
what it is. So here's the thing. It's, in reality, we work with 5 or 6 at any given time because in mortgage lending, it's seasonal. There are seasons to the way that lenders and banks lend to us. And what does that mean? It means today I have a handful of lenders that are hungry and have an appetite for more business, more mortgage business. Okay. And how do they show and express their appetite for more mortgage business? Well, first of all, they're reaching out to us constantly. Second of all, their terms and their rates are much more competitive. Okay. And they have some leeway in regards to the rules and regulations that they stretch a little bit, especially when you are talking about having more than a 20% down payment. Okay. So there's that. Now, what ends up happening is how does a bank tell you we have more appetite? They give you better terms and rent. Now, how does a bank tell you our appetite for this first quarter is good? We are full, right? We can't eat anymore. How do they say we don't want your business without saying we don't want your business? They give you rates and terms that are unattractive. And that's how they communicate. So right now we have 5 or 6 that we love to deal with because they want to deal with us and they are actively seeking out our business. And what'll happen is in the spring, when the spring market hits, we're going to have a different 4 or 5. and they just cycle through. And this is just the nature of the business, right? So I think what it is working with a team, having professionals, real estate agents, mortgage brokers that understand this, and can be, full disclosure and walk you through, because you want someone holding your hand through this process, and you want to make sure that, for me, I put people through, I don't want to, but put them through the ringer at the beginning. That way, I want to disclose any potential challenges in the first 20-minute conversation, in the first 2 weeks of collecting income docs, so that I know no boogeyman is going to jump out of the closet a week before closing. We do not want to go that far until we know. And this is why you want someone that's going to do the due diligence, and dig everything up. We're getting uncomfortable early.
Yes, yes. So true. I feel the same way. It's one of those things where no matter what you're dealing with your client, getting ahead of what could potentially go wrong down the road, and you see it early, but you don't say anything, you have to just call it. My next question is around, what do borrowers forget to tell you? What is like one of the most common things that they should be disclosing, but they may not disclose when it comes to qualifying?
It's a great question. And I'm gonna knock on wood here. There have not been a lot of surprises. But what's interesting is that discovery call that I have a document that I use to go through it. And it's funny because it's an ever growing document. It's literally on Google. It's a Google Drive doc that I have. I'm constantly, over time adding new questions to it, and new questions get added to it when new challenges or problems pop up at any point in the journey. And I'm very thankful that lately, that I can't remember the last question, but it's been a while since I've had to add anything to it. But most recently, I'll tell you a story. Most recently, we had a client, for the very first time, the source of down payment they used to make the purchase was actually their RESPs that they had for their children. Now, why was this such a big deal? Because even the bank had never seen anybody do this at the time, right? Because an RESP is essentially an investment where the government is adding additional funds based on what you put into it, right? So you see statements quarterly, and you look at that statement and you see a fantastic number. But in reality, that's not accessible to you if you were to cut it short and withdraw your money, right? So
Right.
there's a big unknown there. And it was interesting for me because I was with the underwriter step by step of the way, and the magic word that we're looking for is that, Ahmed, your broker complete. There are no more conditions to be fulfilled, and that was the one condition. Was the condition of down payment was unable to be fulfilled until very later on, because it took a while to break that RESP, and they couldn't fulfill it because we didn't know what the exact amount was going to be deposited into their bank account when they did. Sure enough,
Right.
and it was great. We calculated what we thought it would be, and we were pretty close to the fact that it was they ended up with, I think, $10,000 more than what they even needed, which was fantastic. And they made that call. And actually, after that experience, I had two more. And I think people are looking at it. Side note, they're looking at this RESP contribution. Yeah, their kids are maybe 11, 12 years old. They've been renting all their life. And it's like, you know what? That might be a better investment. And then build up some equity. And then when it comes time to go to school, they can, take out a line of credit, or they can do something. So they ended up purchasing the house. And in all three situations, they purchased the house using an RESP, a down payment.
Never heard of that before. At
Neither
the
have
end of
I.
the day, it is your invested money. So, what usually trips up sole proprietors when it comes to qualifying? Is there anything else that stands out for you?
I think one of the things that pops up is back taxes owing, right? So, it's not a deal breaker, but what it is it's a challenge, right? So, one of the questions that comes up early on is, are you up to date on your taxes, right? Like, have you filed for your taxes? Are you paying, if you owe, are you paying what you owe? Or is there a balance that's accumulating? Or maybe you've got a payment schedule set up with them. Is that in place? If it isn't, you got to get it in place, or you got to find a way to pay it off before you take the next step. And like I said, it's not a deal breaker, but what it is it's definitely a challenge, because if you look at it from the lender's perspective, they're looking at, potentially lending $500,000 on the low end to somebody for a mortgage. And if anything were to happen, the only entity that could get between that property and the bank is the government. right? And that's why it's so important to number one, pay your taxes, right? And that's why, in the actual mortgage commitment with the lender, one of the commitments is that you are going to pay your taxes. You will pay your property taxes, right? Because if you do not pay your property taxes, then you're potentially putting the property at risk and you're putting the lender at risk as well. So being up to date on CRA docs, very important. And it's very common that whenever I start the process with somebody and this question comes up, we get right into it, ask them for, show me the CRA statements. What do you owe them? Let's see how we can figure this out. And then we put a plan, whether it's a payment plan or whether it's, the government's not going to ask you if you borrowed your mom and dad, $10,000 to pay off your back taxes owing. But I'll tell you what, the bank is going to ask you for the $10,000 you borrowed that you're going to put towards the down payment. So borrow that 10 grand from your mom and dad and put it on the CRA. Get the government off your back first.
The more I talk to you, the more I hear different avenues and different strategies, and you're not, it's not black and white. It's very gray. You're kind of navigating and supporting your client through this journey to make sure that you've uncovered every potential opportunity for them to acquire a mortgage. And when it's an absolute no, you're putting them on a plan so that they eventually will. So it sounds like it's never a no. It's just a not, maybe not right now.
Yeah, it's always a not right now. The only time it's a no is when someone wants to commit fraud.
Yeah, well,
So that's the only no, right? Now, the
absolutely.
thing is, like, you talked about, the different avenues. Like, that's what I love about this. Like, first of all, I love this industry, but
Hmm.
the fact that I get to speak with entrepreneurs and people that are doing things that I never imagined you can make money doing. Like, it's amazing. And it really, at the end of the day, if a deal doesn't go through today, um, and I can, put them on this plan, I get to learn about, these other businesses. And a lot of the times we end up becoming friends where for me, I just have a passion for business, marketing, which was my background, and just generally curious. And I think, as you know, and you could probably attest to, curiosity is the greatest tool that any entrepreneur can have in their toolbox because
So
you
true.
don't know where it's going to take you. But if you are genuinely curious, people want to talk.
Absolutely. So, so true. I hope you've enjoyed part one of this incredible podcast session. If you want to see part two, please click the subscribe button. We'll talk to you soon. And thanks for checking out Rock and Realty.